The global economy is potentially on the precipice of disaster. The Russian invasion of Ukraine, a European breadbasket, is likely to cause spikes in food prices due to interrupted harvests, while a rise in COVID-19 cases has already led to lockdowns in China electronics manufacturing hub of Shenzhen, potentially disrupting production. High oil prices could cripple consumer spending. In addition, US regulators have continued to press American-listed Chinese firms for audits with the threat of delisting if they don't comply. Chinese firms maintain the information sought are confidential state secrets and can be disclosed. Wall Street and Chinese American funds are familiar with Securities and Exchange Commission rules, and they vigorously cooperate to sell short, and Chinese stocks naturally plummet. Tony Ling, a Hangzhou-based partner at Byzantine Capital, told CoinDesk. Ling pointed to JP Morgan's downgrades of 28 Chinese stocks listed in US and Hong Kong, as well as the bank's commitments that Chinese tech stocks are uninvestable for 6 to 12 months as fuel for the industry-wide sell-off in those shares. The recent industry-wide sell-off is likely to continue in the absence of valuation support, he said. All this has hurt Hong Kong's Hang Seng Index, which is a hub for China-listed shares that are accessible to the outside world. Investors have priced in the threat of delisting and accelerating hostilities, and Hong Kong's own out-of-control COVID-19 situation to top things off, giving the market its worst days since 2008. Yet Bitcoin has marched on. It has been a fairly boring week for the world's largest digital asset, because it has been bouncing around plus or minus 2% all week. Yes, in some ways this is what it is designed to do, by acting as a safe haven for capital. However, we've seen in recent months that Bitcoin has begun to trade like a risk asset rather than an inflation hedge, making Bitcoin's absence in this market squeamish curious. It is because capital is headed back to US, where it sees opportunity and is not necessarily fleeing. Or could it be a planned decoupling? The plummeting of Chinese concept stocks is no longer the normal operation of stocks, but something that incites Western funds to decouple from Chinese concept stocks, causing chaos in the Chinese economy. Byzantine's Ling said. More likely, the only thing on crypto's mind now is the Federal Reserve meeting and the announcement expected afterwards. Inflation and interest rates are on the top of the agenda, and crypto is certainly going to once again come up on the minutes. It might be that the crypto market is still centralized around the Fed as the preeminent driver of our macroeconomic policy, making it not much different than TradFi. The minutes for the last Fed meeting are expected to be released soon, unless US-China equity spills over and Hong Kong's market contagion spreads, which doesn't look very likely. It will once again be the Fed that drives crypto prices. Is that a case for further decentralization?